Good afternoon, everyone, and welcome to this week's ZEF Colloquium. It is my pleasure to introduce today's speaker, Sophie van Huellen. Dr. van Huellen is a lecturer in development economics at the Global Development Institute at the University of Manchester, and her research is focused on primary commodities, international finance, and applied econometrics. Today, she will share her insights on function upgrading opportunities for developing and emerging market companies based on the case of Ghanaian cocoa. Sophie, the floor is yours.
Thank you, Sasha. It's an absolute pleasure being here. Let me share my PowerPoint presentation. 1 second. I probably have to switch to the other screen. You should all be able to see the full PowerPoint now. If not, let me know. Excellent. I take this as a yes. Thanks for having me. And today I will present a paper that was written last year, but it's based on different rounds of fieldwork that actually started with my PhD in 2013. So it's quite some time, and it's a build-up of different discussions that I had continuously with stakeholders in that sector. The title of the presentation is also the title of the paper, which is Potential for Upgrading and Financialised Agri-Food Chains, the Case of Ghanaian Cocoa. The presentation will be divided in 5 different segments. I first will give you a brief context of what is the matter, as well as what is our main argument and hypothesis. I will then go on and give you a very brief overview of the literature on financialized food systems. There are 2 different strands there, so a brief introduction of these. Then there are 2 analytical components to both the presentation and the paper. One is based on the analysis of what financialization actually means at the level of the global cocoa chocolate sector. And the next part is how does it play out in the context of Ghana's cocoa chocolate sector, so going from the global to the local. The last segment will conclude with some policy suggestions and discussions. As I said before, the presentation heavily draws on the first paper that is mentioned here, which has the same title as the presentation. That paper is co-authored with a good friend and colleague of mine. It's called Fuad Mohamed Abu Bakr, who is now, since recently, has been appointed the head of CMC based in London, so the cocoa marketing company, has previously worked for CocoaBot in various positions. The second paper is one that influences a little bit the discussion we will have about policy conclusions towards the end. And I'm happy to go into more detail if there's interest there, and I'm sure you have a lot of questions in that context as well. That paper is co-authored with Jonathan Bashiru-Hinder and is forthcoming in the Journal of African Trade. And there we look more into the potential of regional regional sector-based integration and what that means for a commodity-based upgrading in countries that are heavily commodity dependent. The context in which that paper, or the context with which the paper started, is basically the global chocolate industry is worth roughly $150 billion. However, the West African producers of the actual cocoa, which is the prime input factor in producing chocolate, only receive around about 77% of that industry, while at the same time they do produce 70% of the global cocoa beans. The main producer here is Côte d'Ivoire, followed closely by Ghana, and then to a lesser extent Nigeria, which has seen its cocoa production shifting up and down over the decades quite a bit. But most of the value that is generated as part of the chocolate industry, it takes place in Europe and North America. But at the same time, what we've seen since over the last couple of decades is that quite almost perversely, that the region that produces most of the cocoa globally then relies heavily on imports from abroad to satisfy its own chocolate consumption. So chocolate consumption in West Africa is relatively low, but it's increasing quite a bit, especially as the middle class is building up. So a very small market, but a growing market there. And most of that consumption is satisfied via imports from then Europe and North America. So basically we importing their own produce. So the big question then is what hinders function upgrading, which is defined as the move into higher value added sectors, segments of that chain. We look into two different parts of that argument in the context of financialized food systems. So there can be a lot of different reasons that hinder this upgrading, but here we constrain ourselves to looking at what are the implications or the potentials and limitations that financialization pose. And when we talk about financialization, we look at financialization at two different levels. One is financialization at the sector or lead firm level. So basically financialization of global value chains and how that has developed or how that has resulted in a restructuring of how global value chains are being organized, and so on and so forth. And the other part of financialization is financialization at the level of globalized finance. So here we look both at particularly currency hierarchies, and we draw a little bit from a literature that's called subordinate financialization, where the idea is that countries, small open economies that do not have one of the so-called hard currencies, or have engaged with international or global financial markets from a subordinate position in the hierarchy of global finance. So these two hypotheses or analytical angles play out in the two analytical chapters. So one at the GBC level and then one at the level of what that actually means for Ghana in particular. So that's what that little 3 and 4 means. It refers to segment 3 and section 4 of this presentation. What are our hypotheses? We hypothesize that financialization acts as a limiting factor to upgrading. So it is an issue and it hinders Ghana and also other commodity producers from upgrading into higher value added segments. However, it does that with contradicting tendencies. Why is that? So our first hypothesis is that at the level of the sector, that financialization of lead firms has facilitated outsourcing of so-called non-core activities. And that's not specific to the cocoa sector or the cocoa value chain, but happens across global value chains where lead firms are predominantly now oriented towards branding as the value generating activity and have a tendency to outsource the less kind of financially viable activities. That in itself has helped establishing processing capacity in Ghana and also Cote d'Ivoire and neighboring countries. At the same time, that these financialization forces that have led to the outside sourcing of non-core activities have also facilitated an increasing concentration of the lead firm segment of that chain, which further then hinders functional upgrading of, or basically hinders the entrance of newcomers into these segments. The second component where we see contradicting tendencies is at the level of the global financial architecture, where we see that given Ghana's high dependence on primary commodity exports to generate foreign reserves, these foreign reserves are needed in order to stabilize its macroeconomy. A lot of that stabilization efforts comes from the fact that exports are not relatively non-diversified and very export income is very volatile, which is something that we see for a lot of commodity dependent economies. That in itself then necessitates actually upgrading the move into segments where we see higher levels of processing and manufacturing stable, where prices and markups are much more stable and more value is being generated. The question then we pose is whether these contradicting tendencies together constitute a middle value added trap, where basically Ghana is trapped at a level where it does relatively well in processing cocoa at a low level of value addition stage, but has troubles moving into the segment where most of the value is captured, which ultimately is chocolate production. I will now go into to give you a very brief overview of the financialisation literature in the context of both GVCs and food systems. So that's very brief. If you're interested, we can talk about this a bit further in the questions. The main part here is that financialisation is increasingly recognised as a driver for shaping global agri-food chains or food systems, as you can call them. Now, looking at this from the GVC tradition, there is a growing literature that acknowledges, and it's also around the early 2000s, that has increasingly looked at how the growing tendencies of food multinationals or multinational companies in general to outsource lower value added activities has then led to both these activities being often shifted also geographically abroad. So you have a disaggregation or segmentation of the different production elements. And at the same time, we have seen a massive concentration at the level of branding activities. So further downstream via predominantly mergers and acquisitions rather than investment or expansion of the actual productive processes. Now, financialisation of the food in the context of food systems goes actually a bit further. So instead of only looking at how has financialisation shaped or reorganized how global value chains are, or how global value chains are being organized and where they are located, it also looks at or identifies an increasingly blurred line between financial and non-financial players within these systems. And that's quite important, especially in the context of food, but also in the context of other primary commodities. Both of these different literatures observe financialisation of all three lead segments in terms of financialisation of objectives, investments, and operations. So at the level of first-tier suppliers, which is also called grinders or trading houses, so we had often a big trading house that have their origin in colonial times, then merged with processing companies, and they together now form what you can call a first-tier supplier segment. They're very powerful players, although the names are quite unknown if you don't research in these areas. Then you have branders, and you have increasingly also the retail sector, which becomes incredibly concentrated over the last couple of decades. Now we see offshoring and outsourcing being present in all of these segments in order to boost shareholder value. So any activities that are not shareholder value friendly are basically outsourced, and often these are the actual processing elements in the production process of chocolate, and a lot of the branders are actually only engaging in marketing and packaging, if you want, but not the production of chocolate in itself. All of this has strengthened massively the first-tier supplier segment, but it was also facilitated a lot of these activities now being outsourced geographically into other regions, including Ghana. We also see that all these lead segments engage massively in things like share buybacks if they are listed companies, and the growth has primarily happened, especially throughout the long recession, through mergers and acquisition rather than expansion of the productive activities. So that's financialisation of objectives and investment. And for first-tier suppliers and retailers, we also see financialisation of operations, which sees especially first-tier suppliers having as subsidiaries, for instance, hedge funds, but also offer financial services such as insurance and credit to their clients. And that's also something retailers engage in. So their financialisation of their core operations or operative activities. This gives a broad overview how that plays out. So what are the different players in financialised food systems? The figure is divided into goods markets and financial markets, and the different products that are being traded both in the goods market and the financial markets, and how they're being intertwined. So you can see that you have at the bottom all of the financial actors and at the top all of the non-financial actors. the first thing that we observe is that when you look at the outer lines there, we see that a lot of, for instance, hedge funds and equity funds are often subsidiaries of first-tier suppliers. So first-tier suppliers actually hold as part of their core functions now entertain hedge funds or private equity funds. At the same time, investment bank, hedge funds, private equity funds, they're all shareholders of the listed companies in the first-tier supplier, brand and retailer segment. Then what we have is that first-tier suppliers, branders and retailers therefore increasingly also rely on these agents for financing. That can be via debt or equity, but they themselves also engage a lot in buying and selling of equity in order to expand. So that's the merger and acquisition story. We also see that branders and retailers do rely to quite some extent in insurance and risk management to products that are being put together by investment banks in order to facilitate their risk management, and that is often backed by some sort of derivatives that are then being traded at the managed exchanges. We also see land grabbing, both from investment banks, hedge funds, and private equity funds. That usually goes via equity also, which then has land associated to it. At the same time, we see that index and hedge funds also invest heavily, increasingly in the weather, water, food, fuel, fertilizer, and farmland. So all sorts of derivatives that are associated with primary commodities, and that's something that happened or has kind of taken off. As this has always been there, but it has taken off massively in the early 2000s, and it hasn't seen a kind of a decline or to previous levels yet. We also see that large hedge funds, primarily BlackRock, is being one of the most prominent shareholders of these food companies, if they are listed companies. And as I said before, hedge funds are now owned by first-tier suppliers or closely associated with them. And investment banks, but that's not so much the case any longer, have even tried their luck in investing in the physical commodities instead of the derivative. But most of them have ceased doing that due to both massive losses they encountered because they didn't have the actual knowledge of doing that, and then at the same time also changes in the regulatory environment as a response to claims of speculation and so on and so forth. So the line between investment banks, hedge funds, and crops is not so much there as it was maybe 10 years ago. What do we see on the non-financial actor side? We see shareholder payouts have massively increased over the last couple of decades. So you definitely see an increasing power of institutional investors, which demand those payouts. So shareholder payouts have increased, which is usually taken as a sign of financialization within kind of the very common shareholder value doctrine story or part of the literature that talks about financialization. Most of these companies that are prominent in the food system have acquired multiple subsidiaries and often that and now hold them via holding companies. For many of them, that was the prime way of expanding over the last decade. Branders have accumulated often a massive amount of other brands and have diversified into marketing, transport, and then the first-tier suppliers have diversified into market and transport, storage, sourcing, which is all the bits that then the branders have basically outsourced. At the same time, these first-tier suppliers have integrated vertically more than they had before. They were always quite integrated into the chain because they were, as I said before, they are a merger of the old trading houses and the processing companies often. So the trading houses often had strong links with the actual producers, and that's something that they have maintained. At the same time, they also have diversified into non-financial and other and financial services. What they have also done is that they now increasingly using that knowledge given that the segment is very concentrated, that knowledge in order to trade speculatively at financial markets. So that's where the association with hedge funds comes in. They do have a prime knowledge about demand and supply in these markets, and they do exploit that via speculative positions as well as their hedging or risk management positions. This is an overview of different branders and first-tier suppliers that are prominent in the chocolate segment. I have excluded retailers because it's difficult to nail down which are the retailers that are prominent in chocolate. They're prominent in all sorts of products. But these are the branders and first-tier suppliers that are prominent in the context of cocoa and chocolate. What we see is both regional differences. So when you look at the middle part, this is the share of institutional investors in the total shareholding. So who are the owners of the equity of the firm? And we see that especially in the US, these institutional investors hold the majority shares, up to 80% of total shares, which is a massive amount. Singapore is similarly strong, Japan as well, and other countries less so, especially European countries traditionally have a smaller share of institutional investors. What we also see is that over the last 3 decades, there was a continuous increase in the dividends as a percentage of gross profits that are being paid out. So a greater share of profits is being distributed to shareholders rather than being used for reinvestment or other productive activities. On the right-hand side, we have the percentage of goodwill as a percentage of total asset. That's a bit difficult to pin down, but it can be seen or is seen in the literature as an indicator of how much a firm has relied on mergers and acquisitions for growth. The reason is that as soon as a company buys another company, there needs to be a way to evaluate the size of non-tangible assets. So for instance, what's the value of the brand? This is not something that you can evaluate easily, and usually that ends up in an account that's the goodwill account of the firm that acquires the other company. So the more inflated that goodwill account basically is in untangible assets like the brand name, the larger the share, the more the firm tends to have relied on mergers and acquisitions for growth rather than expansion of productive activities. We also see a number of subsidiaries that are being held by these companies, and especially for Mondelez and for Nestle, we have at least a minimum of 200 subsidiaries, but also Cargill at the first-tier supplier segment comes close with 184 different subsidiaries. So they're very well diversified companies. We don't see any of these subsidiaries engaging with financial services as their prime operative activities in the brander segment, but we see that very heavily in the first-tier supplier segment, which makes sense given that these are trading houses which have always been active on the derivatives, in trading derivatives. So they have a very long-standing capabilities in doing that, and now they increasingly use that both as a standalone service that they offer to their clients, both upstream and downstream, but also use that in order to engage with these markets speculatively. So those who have a yes there do entertain at least one subsidiary that has as a prime operative objective purely financial activities. I do have to be careful about time. So let me maybe jump to this slide immediately in the interest of time. This is just a slide to now move. Let's move to so we're moving to the cocoa context in the sense of how financialized are cocoa derivative markets. And these are just two graphs which show that relatively nicely. We have seen since the early 2000s, or since the 90s actually, a massive increase in what's called open interest. That's basically the number of contracts that are being traded at registered exchanges. That in itself is not necessarily a negative thing. It's also contributing massively to liquidity of these markets and the correct functioning of these markets. However, we have seen that the growth, especially after the crisis, has been extraordinary compared to the growth we have seen in the actual physical production of cocoa beans, right? So ideally, you see this activity, you see open interest as a reflection of traders or trading houses who are trying to manage their risk exposure by holding physical cocoa. Now, that has always been the case, but now we see an entrance of a lot of other actors like hedge funds, managed money, and institutional investors that also contribute and hold to that open interest. That's the right-hand side. On the left-hand side, we see the percentage share of that open interest that being held purely by index traders. Index traders are the same like when you have a stock index that you invest in. It's the same exists for commodities. You have an index of different commodities. These are purely passive investors. They just are pumping liquidity in these markets and often have been accused of therefore giving the price an upward bias, and when they enter, and the downward bias when they extract from these markets. So they have quite a heavy price effect, especially if their relative size or weight of market is relatively large, and it is relatively large with about 30%. What are the implications of these financialization tendencies? So that's both the financialization in terms of how lead firms operate, and also how they now increasingly also engage with financial activities as part of their core business. The first implication is horizontal concentration. So given that mergers and acquisitions were prime areas of growth for these companies, we now see, for instance, that half of the world's grinding business, which is the basically processing of cocoa, that's the first tier supplier segment, is dominated or in the hands of just two companies, which is Cargill and Barry Callebaut. So two companies are the sole buyers and processors of all global cocoa that is being produced. We also see increasing vertical integration and control of this first tier supplier segments over the actual growth process of these of cocoa beans, and often that is linked to the need of these firms to have a good idea or good information about future demand and supply. That means that the competition at the grinder and brander segment heavily relies on access to international finance. There's a scale economy for the first, massive scale economy for the first tier supplier segment. So that was always a very difficult segment to enter as a newcomer because it's very capital intensive. But also the brander segment has become so concentrated that it's now very difficult to enter, especially if you do not have access to internet or easy access to international financial markets. At the same time, given the entrance of passive investors and speculative investors in commodity markets, the revenues generated by cocoa trade have become increasingly volatile, which even makes a bigger case for the need of countries that produce cocoa or primary commodity to diversify into higher value added product spaces. We now move to Ghana's cocoa chocolate sector, which there are lots of technicalities there, so bear with me. Some of it might seem a bit descriptive and long, but it will have a point, so it will be important to make the argument we wanted to make here. So please bear with me, and I can respond to any questions later on. Now, Ghana is the only country without a fully liberalized cocoa market. The Ghana's Cocoa Marketing Board, or Cocoa Board in short, is a descendant of colonial times. It has been introduced by the British during colonial times in order for various reasons. One is because there was a lot of political unrest at the time, and also the UK needed to fund its war efforts, and it was an easy way to extract revenue from the sector and control it. So that was the prime objective at the time, to install a marketing board, and it has survived ever since. It's the only marketing board in the cocoa in cocoa that has survived since then. Cote d'Ivoire has recently reintroduced its marketing board, but with very different powers than Cocoa Board has. Now, all cocoa that is produced in Ghana has to be sold via the so-called Cocoa Marketing Company, or CMC in short. CMC is a subsidiary of the Ghana Cocoa Board. So a subsidiary of Cocoa Board is semi-state owned. You cannot buy, if you're an international buyer or even a domestic buyer, you cannot buy a single bean of cocoa unless you buy it from CMC. Otherwise, it's not possible to get hold of Ghanaian cocoa beans. The domestic sourcing of cocoa is in the hands of so-called licensed buying companies. These licensed buying companies, or LBCs, are registered with or licensed with CMC, and they have a fixed margin for the turnaround of cocoa. So they basically drive to the farmer and then collect all the cocoa, check the quality, and then deliver it to a CMC warehouse in 3 so-called cocoa ports across the country. For Ghana, relatively few of these LBCs are owned or affiliated with multinational companies. Although those multinational, those first-tier suppliers that are also very active in financial markets for speculative purposes, so those who entertain hedge funds, they are all present. They're all present because, of course, if you are the one that actually collects the cocoa from the farmer, you have prime knowledge about how much cocoa in a given crop year is coming in, and also how, for instance, weather and so on and so forth will affect future harvest. Cocoa Board has a peculiar and very specific to Ghana forward selling system. So what Cocoa Board does is it sells forward its predicted crop. So it predicts via its statistical department how much is going to be harvested in the upcoming crop year, and 70% of that is being forward sold. What does it mean? It then enters into a contract with, let's say, Barrick Calabout over a particular amount of cocoa beans, and that contract is being settled at some point in the future after the harvest actually takes place. This forward selling system is then used in order to source financing or US dollars, in particular offshore. Now, if Cocoa Board would try to borrow the CD, so the domestic currency, that it would need in order to buy cocoa beans locally, it would face a massive financing cost, because the interest rate that could be offered by domestic banks is incredibly large. So it's much cheaper for Cocoa Board to actually source that financing offshore, and they're doing that in London via the Ghana International Bank, and this is what's shown here. So how does that system actually work? Now, CMC, which is in the middle here, CMC gives Ghana CD to the licensed buying companies, who then buy that cocoa from the farmers and then return the cocoa to CMC. The CMC gets these CDs from the Bank of Ghana. The Bank of Ghana is able to extend these CD to CMC because it got all the US dollar loans that are acquired via a syndicate loan system that is backed by the forward selling contracts that CMC engaged in with international buyers. So CMC sells forward its cocoa beans, has contracts with international buyers. These contracts are then used as collateral payment to engage or to source a syndicate loan, which is a syndicate of foreign banks. You agree to engage in a loan at a relatively competitive rate. that US dollar amount is being transferred to the Ghana International Bank, which is a subsidiary of the Bank of Ghana, the central bank. And then that US dollar is acquired by the central bank, so Bank of Ghana, goes into Ghana, and then they transfer that into CD, which is then extended to CMC. Once the cocoa is being delivered, all of the international buyers pay the Ghana International Bank, not CMC, in US dollars, and the loan is then thereby repaid. The problem here is that it's only international buyers who are deemed creditworthy, and very few, maybe one in recent years, of the domestic buyers that are deemed creditworthy enough so that their forward contracts can be used as collateral. Therefore, the Ghana International Bank, that is based in London, has both a non-syndicated and a syndicated account. So the syndicated is the one where the big buyers, which is used for the syndicate loan system, and the non-syndicate is just to then basically get the amount that is being paid in US dollars by the other buyers that are not so creditworthy. It's a very smart system which has many benefits, but also an incredibly amount of costs attached to it. So the benefits are that CocoaBot can actually achieve a funding rate that is way cheaper than it would be if it wouldn't engage in such a syndicate loan arrangement. At the same time, the Ghana Central Bank gets hold of US dollar reserves, which are urgently needed in order to stabilize the macroeconomy. So it seems like almost a win-win situation. The costs, however, are that the problem CMC faces is that by September, the syndicate loan has to be agreed. Otherwise, it's too late to finance its cocoa operation, and it would go into, would basically face a liquidity crunch. Now, all of the big buyers, and we remember it's only two who hold 50% of the global market share, all of the buyers that buy from CMC know that. So they can play CMC, that they know they have to engage in forward selling and can pressure them to sell at a time where the price for them is actually not favorable in order to get enough collateral to engage in the syndicate loan. The other problem is an over-reliance of the central bank, so Bank of Ghana, on cocoa income in order to get its foreign reserves in place. And that causes, and has caused in the past, pressure by the Bank of Ghana on CocoaBot to oversell. Why? Because if Ghana is in financial difficulties or in macroeconomic difficulties, let's say CD is depreciating rapidly, they are in need of foreign reserves. Now, they have very few levers to pull in order to get their hands on this foreign reserves if they don't want to go to the IMF. And the only one is basically cocoa. The problem then is if CMC oversells its beans, it then has to default on some of the contracts, which of course then makes it less creditworthy and risks future syndicate loan agreements, as well as the favorable interest rates they're being offered. The other problem of that system is that global trade is denominated in US dollar, and the buying and selling of cocoa beans globally is no exception. However, for, again, colonial past dependency reasons, Ghanaian and other West African cocoa is benchmarked against the IS Euro based in London, which is previously called Life. And that contract is denominated in British pounds, so pound sterling. That means CMC exposes itself by doing that to also an exchange rate risk between US dollar and pound sterling. So it's not only CD against US dollar that is a risk in that transaction, but also US dollar in Great British pounds. And when we had the issue with Brexit, that year meant a massive loss for Ghana at the time. So it's a substantial risk component. What does that mean for the opportunities of domestic value addition? So that was the technical component, and I asked you to stay with me because I know it's a bit complicated, but I promise you I will pull the strings together. So what does it mean for the domestic value addition? Currently, the Ghanaian government incentivizes value addition via two different policies. One is to give a bean discount to domestic processors, but this is only on smaller, lower quality beans, and they are being sold domestically at a discount. However, they still sold in US dollars. So no domestic processor can buy beans in CD in the domestic currency. It has to be settled in US dollars. This is in order to ensure that CMC and ultimately the Bank of Ghana gets the full US dollar amount on the cocoa crop harvest. The other is economic free zones, which offer tax exemption for companies that are at least where the produce is at least 70% for exports. The problem is that a lot of the domestic processors do not have access to US dollars. How should they have? So they would have to borrow US dollars from domestic banks. Domestic banks have very limited or no access to US dollars. All of the US dollars sit with the central bank. So they massively disadvantaged. So even if they are able to borrow US dollars in order to acquire the cocoa beans, they then need in order to process, they get that on very unfavorable terms. Right, so they pay much higher interest rates. That's of course not a problem for any of the multinational companies that are also operating in Ghana and processing cocoa there. So Barry, Cargill, and Olam, three of the top grinding. So Barry, Cargill, we already introduced. Olam is a Singapore-based one that is rapidly increasing in size as well when it comes to cocoa. They all have processing plants operating in Ghana. They don't have that problem because all the headquarters are located in many of the international financial centers and they have easy access to US dollars. Now, despite this massive limiting factor, which is born out of this need of the Ghanaian central bank to keep a very strong grip on the US dollars that are being sourced via cocoa export. Despite that, most of the growth that has happened in domestic processing over recent years actually been driven by domestic companies rather than multinational companies, which is a quite interesting observation to make. And this graph shows this. So we show on the left-hand side is the share of total processing basically that is being done in the country that is being done by Ghanaian, solely Ghanaian-owned multinational or joint venture companies. And then on the right-hand side, that's the line with the dots. That's the total amount of processing that is happening in the country. So we have both seen an increase in processing capacity, and that increase in processing capacity is majorly driven by an increase in capacity by Ghanaian-owned companies, so solely domestic-owned companies. Who are these companies? Primarily three. So we have the cocoa processing company, which is the former state-owned company, which had various problems in the past, but is one of the few and for a long time the only producer of chocolate that can be bought and is consumed domestically. Since 2007, we also have Niche, which was established in Tema, which is close to Accra. They started initially with producing liquor only, which is the lowest processing stage, but since 2017 have also started producing higher value added products, including consumer chocolate, and you can now actually buy the consumer chocolate in local supermarkets across the country. Then we have Plot Enterprise. They're relatively small compared to the other two, and they're also engaging in processing, but not in production of actual chocolate. What we also see is an increasing amount of small artisan chocolate makers that emerge in Ghana, and they're usually of the confectionery type, so they're not producing chocolate bars for mass consumption, but very kind of high quality artisan chocolate that is then used often like for birthday presents and stuff like that. However, despite all of these activities mushrooming, the growth in that segment is still stunted. And why do we say that? We say that because the demand at the moment exceeds what is being supplied domestically, which is almost absurd given the amount of cocoa that should be at the hands of domestic producers. And a lot is still being satisfied by imports, keeping in mind that the overall chocolate consumption per capita is very, very low compared to Europe, of course. The other thing that we observe is that domestic processors are heavily indebted against CMC because they cannot satisfy the US dollar requirement in order to require beans. They also have very little capacity or capabilities as well as capacity in managing their risk exposure, which is something that multinational companies do by trading in kind of the global derivative markets or international derivative markets, and that's not something that they can do. The other thing that we see is that, and it's heavily complained about by the artisan chocolate makers, that everyone who imports chocolate, and de facto, if a company sits and produces intermediate chocolate products or cocoa products in the export zones, and then a chocolate or artisan chocolate producer would buy, let's say, cocoa butter from a company that's located in these export zone, then this is being accounted for as an import. Although, of course, the export zone itself is located in Ghana. Now, all imports on chocolate or intermediate cocoa products are, as well as sugar and stuff like that, have an excessive tax of 60%. So of course, that's something that the artisan chocolate makers, that puts them in a massive disadvantage compared to the multinational companies that have sourced the inputs at least cheaply, and then it's just the final product that is heavily taxed. What are the policy conclusions from all of these different facts that might constrain or motivate the sector to grow? We can establish that cocoa beans are still and will remain for a considerable amount of time the primary source of foreign reserves for the Bank of Ghana. So it's the only export item that it has reasonable control over. So the only other source of US dollar liquidity to bring in would be via IMF loans. Now, selling less of that unprocessed cocoa beans forward or selling it at domestic currency would mean that less US dollars could be borrowed at a given point in time, and also at less affordable rates. So that's not a desirable outcome for especially the Bank of Ghana. Now, any upgrading strategy that relies on either supplying domestic processors with cocoa that can be settled in domestic currency, or where some of that cocoa is being processed domestically but not being settled in US dollars, that cannot work. At the same time, if great amount of that cocoa that's domestically produced is not being bought any longer by the large multinationals, which are deemed creditworthy and therefore can be used, their contracts can be used as collateral for the syndicate loan. Anything that threatens these two factors will not be a viable upgrading strategy. One might argue that maybe in the long run this should be the case, but it's not politically feasible. So therefore, the country is running risk of entering or ending up in a middle value-added trap where it keeps at the stage of kind of semi-low value-added processing. However, there are a couple of ways forward, and some of them have already been implemented by CMC and also other stakeholders in the sector. So what is needed is a system that preserves that foreign exchange earning, but at the same time does support the domestic chocolate industry. One of the ways that can be achieved could be via regional markets with a fraction of the chocolate that is being produced. So as I said before, the domestic and also regional market is comparatively small yet, but could be a very viable training ground for domestic chocolate producers to expand and become increasingly competitive. And that's something that I elaborate on in that paper, the second paper that I introduced at the beginning, which is forthcoming. And what we then suggest further is to utilize Ghana's existing cocoa marketing system, which is unique in itself. So the marketing solely via CMC, which has the monopoly on Ghanaian cocoa beans, to actually overcome some of the constraints the domestic producers or processors face, and thereby giving them a slight advantage, or at least overcoming the disadvantages they face. So for CPC, which is the cocoa production company, formerly state-owned, as well as Vamco, which is another very old processing company, for those companies, they were incredibly indebted to CMC, to the extent that at some point CMC entered into a difference, so they were not able to produce any longer because CMC couldn't get them any more beans. The agreement they made with CMC was then that CMC would sell forward their intermediate products via the networks they have with the first-tier suppliers. And by doing so, they have an insurance that they will get the return on these intermediate products onto their accounts, so they can settle in US dollars the bean requirement that these companies need. So this way, at least some of the domestic companies would overcome the US dollar requirement. They would also be able to manage their quantity risk a bit more effectively. So by basically going into a contract with a buyer of their intermediate products before they engage with the processing, and they would gain better access to overseas markets. So that's something that we already see for these companies. So what we have all together, and this is the final slide, and then we can open the floor for questions. 6 different policy suggestions. One is extending this forward selling service, potentially separating it from CMC, which is still a state-owned company, and a lot of the private-owned processing companies, for good reasons, are quite suspicious of the state mingling with their produce. The second suggestion is the leverage of the African Continental Free Trade Area, or also the ECOWAS Free Trade Area, to develop a regional chocolate industry first. There are various obstacles to that. And the 6th point, actually, it's the 6th point here, speaks to the first one. One of the suggestions we make in the second paper is to introduce a cocoa regional industrial policy, which can be then facilitate greater sectoral regional integration. And what exactly that means, we can talk about, but would probably be another presentation. The 3rd point is to develop a financial strategy that does not rely so much any longer on the annual offshoring, so of the offshore loan to acquire US dollars. That system of being timed in September, as I said before, puts CMC as a disadvantage, because international buyers are aware that this is the point in time they need to sell. So therefore, they keep prices low, and usually they increase afterwards. So that puts CMC at a disadvantage, but also the country, because if you plot the CD exchange rate against the US dollar, you can always see a massive dip around September, November, and that blip is then associated with that massive amount of US dollars coming in. The other idea or suggestion is to ensure greater independence between COCOBOD and the Bank of Ghana, so that the Bank of Ghana cannot pressure COCOBOD to oversell, which does threaten the functioning of the entire system. And the last suggestion is to add tax incentives, or basically reduce the 60% import tax domestic or artisan chocolate producers face at the moment, in order to at least support that really small but important domestic sector in the chocolate producing element. And that's it. Thanks for listening, everyone. And I know some was quite technical, but yeah, I'm very happy to answer any questions, and if there are.
Yes, thank you very much, Sophie. Well, impressive presentation. Thank you very much. Very interesting, and I believe you enlisted some new readers to your papers, and also, well, without further ado, we have 3 minutes left for questions. So please either use your raise hand function, as Adri Castro already did, or write your questions in the chat. We have only a couple of minutes, so please, Andre, go ahead.
Yeah, thank you. I'll try to make it short. It's good to see someone from GDI. I did my master's there, so it's very nice. And I wanted to know, one of your conclusions, you mentioned supporting a growing processing industry of cocoa. I'm particularly interested in that. The question I would like to ask you is, how do you think that export taxes as a way to promote value addition locally? For example, many governments, they impose a tax on exporting unprocessed raw material like cocoa, like cashew nuts, like palm oil and whatever. I think you probably don't think it works based on your conclusion, but maybe I'm misreading. And what other policies could you see governments adopting to promote the processing of these raw materials instead of simply, I understand that the export is very important in generating foreign reserves, but if they export it processed, they could make even more dollars. But I know this is something to the medium to long run, but how do you see that?
Do we want to collect? We probably don't have time to collect questions, so let me respond immediately. Okay, thanks, Andre. And yeah, great to see a fellow Mancunian. So tariffs are an important tool. And one of the arguments we make actually in the other paper is that regional markets, so there's this in-out argument, right? So you kind of need to engage in global value chains first, but then because you stock at the medium level, you need to disengage, and maybe regional markets are then an opportunity to basically build the capabilities and also the size in order to then be internationally competitive. So that's the idea of like saying, let's harvest the potential regional markets can offer there. And in this context, yeah, very much input substitution hasn't worked on the grand scheme of things, but it can work, I think, as a relatively short-term or shorter-term policy tool, and also in that context for many sectors, especially when we look at the East Asian example. It has, I mean, you can argue that it has been effective for other sectors. The argument we're saying, if you increase domestic processing, then of course you add value, and that value means that you get more from your cocoa beans. It is correct in itself, but there are a couple of obstacles here. The first is that the processing that's done by these multinational companies, none of this benefits the Ghanaian government or the Ghanaian people much. The reason being that it's internal pricing. Most of the products are being traded internally to their parent company abroad. The internal pricing doesn't account for much value addition, and often it doesn't necessarily show up as anything meaningful in the export balances. So that value addition is very, very small. You can't rely on these multinational companies to facilitate that. And that's something that the Bank of Ghana is very aware of. Therefore, it kind of maintains a very strong grip on the raw cocoa bean incomes. In the long run, that could be facilitated by purely domestic processors, which of course don't have the ability to do internal pricing unless they become multinational companies as well. So their exports actually count towards generating US dollar reserves in a meaningful way. However, their exports are relatively small, and they do have to compete with these giants. So if they compete with these giants, that's very, very difficult because as I said before, especially processing is a very capital intensive, and you need a massive amount of liquidity and therefore access to cheap financing. And that's something that, I mean, there's no coincidence that all of these first-tier suppliers have their headquarters in the international financial centers, because that's where they get their financing from. You need to finance tons of cocoa. I mean, these are millions that are being turned over for each harvest in each country. And Ghana doesn't have a domestic banking system that can support that size of operation. And that's a massive drawback for domestic processors or first suppliers at the moment. So yeah, a lot of other factors need to fall into place. That's why I'm saying maybe the regional route first might be better, and then you can open it up and increase it in scale, where then actually you generate US dollar incomes from that processed cocoa at some point.
Thank you very much, Sophie. The time is unfortunately up, but I'd like to address one question that came up in the chat because it's quite interesting, and it deals with the bundling of forces and interests of African cocoa producing countries, OPEC style. And why do you think?
Excellent questions. Yeah, we had, I mean, there were various attempts in the past. Usually it was kind of the prisoner dilemma, right? So at some point, always someone defected, and then the agreement broke. But there's another, I mean, especially in the West African context, there's a lot of political economy issues that are going on there. So you have Nigeria, who's the largest consumer country, right? It's one of the most populous countries in the world. So that would be the consumer base itself producing cocoa, but not at a meaningful level. But at the same time, having for decades now aspirations to build a domestic chocolate industry has failed so far, but is blocking chocolate that is being produced from Cote d'Ivoire and Ghana. Then you have the issue of the Francophone countries still having the ECO that is linked to the euro. And that causes a problem because the Francophone countries then trade with the non-Francophone countries. It's also something, you have internal blocks there happening as well. So most of the chocolate that's being produced in Cote d'Ivoire, actually all of it, is being exported to France because it's being produced by a French-owned company. But Ghana and Cote d'Ivoire, on an upside, have recently worked actually together on trying to ensure a living standard for their farmers. So they have tried to enforce a living wage differential on the cocoa that they sell. So started to almost agree on prices to some extent, at least coordinated, which has worked wonders when it comes to smuggling, because before a lot of cocoa was smuggled across borders depending on which country the price was highest, of course. And the unfortunate thing is that they tried to introduce that living wage differential when COVID hit, and that put them at a disadvantage, and they were only semi-successful with that because all the companies who promised to honor that agreement then quickly withdrew when COVID came and used that as an excuse to basically not pay that differential. But I think in the future, at least Ghana and Cote d'Ivoire do collaborate quite a bit, but you have to think about, I mean, there's so much politics going on, and the competition within the region, and that you have to find a way to give everyone something that truly benefits their economy, and that will only be achieved by very long, detailed negotiations between these economies. But yeah, that's kind of oh yeah, very good, George. I think some of it is in George's answer there already. But the second paper I mentioned on the regional integration, that talks more about this. So the potential of maybe at least the region to work together when it comes to this. And they produce 70% of global cocoa. So they are heavyweights. So it's not that, and the buyers feel that. So it's forces of power on both sides. So there's potential there, but also a lot of political hurdles to jump, especially ECOWAS is not as any institution, is not the most versatile and the quickest to respond. I mean, even the OECD is so ridiculously slow on things. So yeah, but maybe there's potential there. I think there is. So that's at least what we argue in the second paper. But I've also put my email address. So if anyone is working on similar things, or you just want to discuss and have a coffee or whatever, just send me an email, and yeah, always happy to to talk.
Great. Thank you very much, Sophie, for this interesting presentation and also your the discussion. That's it for today. Thanks everyone, and see you in the next colloquium. Thanks and bye.
Thanks for having me. Bye bye.